Hello friends, welcome to the mini marathon of Module B. Yesterday's Module A mini marathon was a great success, I've seen. Many of you have followed this because numericals were taken so, and also there was a yesterday, did you see that Power Pack Revision series first lecture? So many Forex numericals were taken. Join the Power Pack series. From today they are not available on YouTube. Join the paid class. Hardly few bucks. Okay. Join it ASAP. I'll show you at the end how to join. Don't miss. Today is with Module B. Here also I'll be solving many numericals, theory, objective questions, everything. So you'll get a complete knowledge. Like the video, subscribe to the channel, click on the bell icon. Okay, don't miss this. Share it with your friends also. Right? Many important numericals will be taken. Many important theory parts will be taken over here. It's all useful. See, hardly 4 days are remaining now for the exam, isn't it? Hardly 4 days. Today is gone. And 1 or 2 days will go like that only. We don't even come to know how the time passes. So join the class ASAP. Okay? So let's start. Okay? A dash framework will translate organizational strategy into appropriate functional level goals which can be tracked and monitored at the right levels and frequency to deliver predictable improvement in metrics like ROA and thereby valuations. So which framework will help the bank to achieve the ROA? See, all these things are okay. Simple logic. In exam, you have to first remove the scraps from the problem. Remove what is not required. Simple logic is which framework and it will help you to achieve this ROA. Simple. Which framework will help you to achieve the ROA? That's what the question is. Profitability based performance management, business based performance management, revenue based performance management, and asset based performance management. All of you will think everything is correct. What's wrong in it? So frequency and deliver predictable improvement in the metrics like ROA. Now for this you need to first understand the meaning of ROA. Okay? ROA you have to understand the meaning. Return on assets. Once you understand the meaning and full form of ROA, then immediately things become easy. Return on assets. So asset-based performance management. Simple, isn't it? For that you should know the meaning of this ROA or full form of this. So the answer is this. Asset-based performance management. If you want to get into the metrics like ROA, what is ROA? What are my total loans and what are my total returns from that? Interest part. So that's basically ROA. Got it? To improve ROA and reduce variability in the performance, banks need to take forward-looking windshield-based approach to performance management rather than backward-looking rear-view-based, mirror-based approach. This would include which of the following framework? So, forward-looking approach, see, understand the question first. Do we want a forward-looking approach or do we want a backward-looking approach? That's the only question. Do we want a forward-looking approach or do you want a backward-looking approach? That's the only question over here. Yeah. A SMART. What do you mean by SMART? Specific, measurable, achievable, relevant, and timely. KPI framework and hierarchy for each business. Linkage of ROI targets to lower level financial goals, lag indicators, and operational parameters, lead indicators, and mapping them to the organizational hierarchy. Improved linkage between ROI improvement and the compensation and reward structure and all of these. Pay attention to the question first. Observe these options also. SMART. Specific, measurable, achievable, relevant and timely. Full form of SMART. This full form can also come separately in the exam. Specific, measurable, achievable, relevant and timely. So do you need these elements? If you want to measure the performance of any bank, do you need these elements? Obviously you will need it. Smart technique. So this is true. Linkage of ROA targets to lower level financial goals, lag indicators and operational parameters, and mapping them to organizational hierarchy means giving specific targets to specific persons, to a level-based person. So do you need that? Obviously your regional manager will have higher targets than you, isn't it? Because the regional manager is controlling the region. You are in the branch. So hierarchy based. So that is also right. So this is also true. Lead and lag indicators. Understand the meaning of lead and lag indicators. That is also important. Lag means what? Which will give you the solution or the analysis after the thing has happened. Lead means it will give you the solution or analysis before the thing happens. What can happen in future? Lead. This is also called as back testing and stress testing. Okay. So here ROI linked to the lag indicators and lead indicators. So that is also true. Improved linkage between ROI improvement and the compensation and reward structure. Target based, simple, target based. You do this much, you will get this much. You don't do this, you won't get it. Should we do the same in the banking? In fact, it is done in the banking. Right now also it is done in the banking. Okay, so the answer is all of the above. This is the right answer, D, all of the above, because all of them are compulsory if you want the bank to grow, isn't it? In the final phase, starting in the 90s, the government set up Narasimham Committee to manage the major reforms including liquidity standards in the banking sector. Which of the following is not the recommendation made by the Narasimham Committee? Kindly note, Narasimham Committee was an important committee in 1991. This committee, because of this committee, whatever banking we are seeing today, the speed, the private banks, the competition, it is because of this committee. Earlier, before Narasimham Committee, the Narasimha Rao government, okay, that opened up the economy. Before the Narasimham Committee, the banking was very sluggish, very sluggish. Now the banking has changed a lot. So, which of them are not the recommendation? Regulation of interest rates, reduction of CRR, reduction of SLR, opening up of the sector for the private and foreign players. What was not the recommendation? Kindly focus the question. Not the recommendation. Narasimham Committee was actually against this. So you want not. Narasimham Committee was against this regulation of interest rate. It clearly said that RBI should come out of this job of regulating the interest rates. Before that, if you see, banks were given the FD rates also by RBI. FD rates also. Loan rates were given, but FD rates also by RBI. Means RBI gave literally the loan rates and FD rates to the banks. So Narasimham Committee was against this, and this was not the recommendation. Remaining three were the recommendation: reduction in CRR, SLR, and opening of the sector for private banks. Among the below mentioned ratios, which of the following is not a part of common profitability ratios? So profitability, which of them is not the part of profitability ratio? Now for that you need to first understand what are the types of ratios. Ratios are of three types mainly: profitability, solvency and turnover. Okay, profitability, okay, second is solvency, and third one is turnover. TOI, write it, turnover. These are the three main types of ratios in ratio analysis. Profitability has 5 types of ratios. Okay, PE ratio, PE and this EPS. Okay, gross profit, net profit, and overall profitability. These are the 5 ratios in profitability. PE, EPS. Okay, so PE, EPS, gross profit, net profit, and overall profitability. Got it? Next. Now, which of them is not? Which of them is not? Kindly note, not a part of profitability. So, 5 ratios I gave you regarding profitability: gross profit, debt margin, operating margin, and return on assets, return on sales. So, which of them are not the part of profitability? Gross margin, gross profit ratio, it is there. Operating margin, operating profit, it is there. Overall profitability means operating. Return on assets, again it is there. Debt margin is different. Debt margin is not the right answer. It's not the part of these 3 ratios. Okay, it's actually, you can relate this to debt equity ratio, but that will be the part of debt equity, that will be the part of solvency, long-term solvency. Remaining 2 I'll explain you whenever some topic comes. Okay, so the answer is this. Required answer is this. Debt margin is not the part of your profitability ratio. Got it? This is not the part. So got it? Debt margin is the answer. Debt margin. Okay? Among the below given, which of the following actions to be taken for implementing the strategy objectives? Strategy objectives, okay? Implementing the strategy objectives. So, long-term strategy. To build a benchmark issues by issuing significant volumes and take advantage of the liquidity premia. Difficult words, isn't it? Elongate the maturity of the debt portfolio. Build a balanced maturity profile and supply along the yield curve, and all of the above. Strategy means you are thinking of long term. Whenever you are thinking of long term, the first question comes in mind is yield curve. Yield curve is something which is very important for long term survival of any bank. So obviously this answer will be there. Build a balanced maturity profile and supply along the yield curve. Elongate the maturity of the debt portfolio. This is also one of the important strategies. If you have the loans of longer duration, okay, loans of longer duration, and similarly deposits also of longer duration. Not too long, because deposits too long is always a risky part. If you have it linked to the repo rates, then it's okay. But deposits in our country as of now, we are not in the repo rate style of deposits. Loans we have repo rates. So always the more longer you have the loans linked to the repo rates, the better it is for the bank, isn't it? So this is also elongate the maturity. That is also true. So now if 2 are true, obviously the answer will be all of the above. But for that you will have to check first whether this first one is also true. To build a benchmark issues by issuing significant volumes and take advantage of the liquidity premia. If you are having a liquidity, huge liquidity you are having, means you are having excess funds. Take advantage of that. Liquidity means what? The bank is having excess funds. So if I am having excess funds, I will lend it at a lower rate. So take advantage. All of the above. Correct? D is the answer. Which are the reinforcing pillars of Basel II revised framework? Minimum capital requirement, supervisory review, market discipline. A and B, B and C, C and A, B and C. See, Basel II revised framework. So which are the pillars? Is it minimum capital requirement, supervisory, market discipline? This is the easiest question for CAIIB level. This is the easiest question for CAIIB level. Think over it. Let me see. This you have done it in your JAIIB also, isn't it? So the answer for this is all the three. All the three are important. All A, B and C. Okay, all the three are important. In fact, Basel 3 also has the same ones. Only in Basel 3 what you have, everywhere you have the word enhanced. Enhanced. Everywhere. Here also, here also. Basel 3 has only one word which is added, that is enhanced minimum capital, enhanced supervisory review, enhanced market discipline. Pillars are same. Okay? Which of the following stress testing techniques specifies the shocks that might plausibly affect several market risk factors simultaneously if an extreme but possible event occurs? So, which will give you all the events occurring at the same time? All the events. It can happen. Repo rate is going up, then there is a war going on, GDP is going down, your bank is facing the problem internally. All the things can happen at the same time. So, simple sensitivity, scenario analysis, maximum loss and extreme value theory. Which one will give you the scenarios of various market risk factors, several market risk factors simultaneously? Many of you will get confused over here between this and this. Or some of you might think this also, maximum loss. Okay? Maximum loss also, because some of you might think maximum loss, all the things coming at the same time, so maximum loss. But it's not the answer. Maximum loss is not the answer. EVT is also not the answer, because EVT is different. EVT is not all the things coming at the same time. EVT is basically the market crashes like never before. That's called as a tail concept. So this is also not true. The true is this one. Scenario analysis. Various scenarios you have to consider and take various options into consideration. Various points can happen. COVID can happen, your interest rates can suffer, there can be a war between various countries. All the things can happen. So that's why scenario analysis is the right answer. Scenario. And in that also, in scenario you have one basic method, means various scenarios are considered over here. Okay? Means all good and bad scenario. What is scenario basically? You are basically combining various elements. One name in that is Monte Carlo simulation. Monte Carlo is one of the best methods for scenario. Okay, you have a lot of questions on Monte Carlo. Kindly note. Monte Carlo. Monte Carlo simulation. One of the maximum asked question in the exam. Okay, read this. Which of the following statements is or are true? Which of them is or are true? Assets and liabilities in the trading book are held until maturity. You want correct one, sir? Mark-to-market system is followed in the trading book. Derivatives are held for trading in the market or over the counter are not the part of the trading book. Derivatives that are held for trading in the market or over the counter are not the part of the trading book. Trading is subject to adverse movement in the market prices until they are liquidated. So these are the four options. Which one of them is correct? Think over it, everyone. Assets and liabilities in the trading book are held until maturity. Is it so? Assets and liabilities in the banking book are held until maturity. So this is false. Mark-to-market system is followed in the trading book. True. What is mark-to-market? Mark to market means notional profit or loss. Suppose if I purchase, let's say a Reliance share today, example I am giving, a Reliance share or any company share. Let's say I purchase it at 2000 rupees. Then tomorrow I am not going to sell it. But tomorrow if the price goes down from 2000, it goes down to let's say 1900. Am I selling it? No. But I have a notional loss of 100 rupees. So if I have this notional loss and if I am in the options market or if I am in the futures market, then I'll have to pay that loss from my pocket, from my savings account. That is called as mark to market. The reverse is also true. If I buy it at 2000 and tomorrow it goes to 2100, I am not selling it. But the difference between the same is given to me. This is generally done in the futures market. Futures is also always mark to market. Okay? Derivatives that are held for trading in the market over the counter, market or over the counter are not the part of trading book. What are the types of derivatives? One is in the market and second is OTC. There are only two types of derivatives in banking. One is ETC, second is OTC. Exchange traded, and second one is over the counter. So if both are not there, what is mentioned over here? Derivatives that are ETC or OTC are not the part of the trading book. Then what is trading book? What is trading book? Trading book means anything, it's also called as a proprietary book. This is also called as a proprietary book. Proprietary means what? Here I am buying the share, buying the stocks, shares or commodities or bonds for my own profit. Own profit. I as a bank want to earn the profit. So that's why I am buying it. So derivatives are held for trading in the market or over the counter are not the part of trading book. So that is false. That is a part of trading book. Okay? So 2 is correct up till now. Trading book is subject to adverse movement in the market prices until they are liquidated. What do you mean by this word liquidated? I'll give you a simple example. Again, the same example. I buy a share of, let's say, Reliance or any company. I buy that share. So up to what time will I be concerned about the price of this company? Suppose if I buy it at 2000. So I will check the prices daily or weekly or whatever frequency it is. What is the price today? 2000 I had bought. Is it 2200, 2300? Is it 1800? Is it 1700? I'll check the prices. But up to what day will I check? Suppose if I sell the share after, let's say, 5 days. Sell that share. I had purchased at 2000, now I have sold it at 2200. I have sold it. So after that, will you check the price again? Unless you have to buy it again. Forget the buying part. But will you check it with the risk factor that whether it is going up or down? You will not check because you have already sold the share. That is known as liquidation. So you will always check the price, or it is always subject to market movements or market prices subject to you have not liquidated it. So 2 and 4. 2 and 4. This is the correct option. 2 and 4. Again see this question. Very important one. Which among the following is correct as per Basel III? Which among the following is correct as per Basel III? Total risk weighted asset equals to risk weighted asset for credit risk plus 12.5 into capital risk required for market risk plus 12.5 into capital risk required for operational risk. B. Total risk weighted asset equals to same. First is same. No, changed. RWA for market risk plus 12.5 into capital requirement for credit plus 12.5 into capital requirement for operational risk. Total RWA, see now. Total RWA equals to risk weighted asset for credit risk plus 12.5 into capital requirement for credit risk. See, both are credit over here. Plus 12.5 into capital requirement for market risk. Third, total risk-weighted asset equals to risk-weighted asset for credit risk plus 12.5 into capital requirement for market risk plus 12.5 into capital requirement for credit risk. So, which one is true? C and D are similar ones, isn't it? Only here they have interchanged. Obviously, C and D are not the answers. See, very frankly, C and D are not the answers. The answer is between A and B. Risk-weighted asset for credit risk plus 12.5 into capital requirement for market risk plus 12.5 into this operations risk. Similarly, over here, market, credit and ops. Answer is between these two only, A and B. So now, which one is correct over here? So the answer as per the Basel, see, it's given as per the Basel. As per the Basel, this is the correct answer, A. Always remember, RWA for credit risk will be given to you in exam. Credit risk will be given to you in exam. Well, that is easy to calculate, that's why it is a standard one. Capital risk for market risk, capital requirement. So, RWA for market risk is never known. That you will have to calculate. Similarly, for ops risk, you will have to calculate. So, as per Basel, this is very correct. Many of you, Rattofai, learn this formula, isn't it? But I'll tell you what is the reason, logic behind this formula. Why this 12.5? Why not 13.5? Why not 11.5? 12.5 means if you divide, see what is the basic CRAR requirement as per Basel without buffer, CCB buffer. In the comment section, everyone, what is the CRAR requirement as per Basel 3 without CCB? It is 8%, isn't it? Right? Comment section, everyone is typing. Let me see. 8%. Right? So it is 8%. So just divide 100 by 8. 100 by 8 divided. What will you get? Let's see. 12 8 is 96. And there's 4 remaining, half. So 12.5. Right? So 8, 12.5 is 100. So from there you get this 12.5. 100 divided by 8. 100 divided by 8 equals to 12.5. You get this. But now there's a catch over here. What is the catch? See, we are covering theory also. That's why. Otherwise, I'll just take the answer and move ahead. We have to cover the theory also, so that you need to understand the concept. Why this? So the point over here is, if you check as per RBI norms, this 12.5 will be wrong. Why? Because as per RBI norms, you have to divide this by not 8, you have to divide this by 9 without buffer. Without buffer, you have to divide it by 9. So 100 upon 9 it is. So it will be different. 9 11s are 99. 11 point something it will be. It won't be 12.5 as per RBI. But RBI even says, see, even Basel 3 says, you have to add the CCB. Even RBI has made it compulsory. So actually, your CRAR requirement is not 9% now. It is 11.5%, 9 plus 2, 2.5. So this CCB of 2.5% has to be added. Kindly note, there are two buffers as per Basel 3. One is capital conservation buffer, that is 2.5, that is to be compulsorily added. So 9 plus 2.5%. Plus, there is a second one, counter-cyclical capital conservation buffer, CCCB. So that has to be added, CCCB has to be added by RBI. Bank doesn't add it. RBI will put it to the banks that, see, from next year, see, 4 quarters it has to give RBI has to give the notice to you as a bank. All this is there in your BFM. All this, every part, whatever I am speaking is there in your book, in your BFM. I take the same in the paid classes. Join them ASAP. Wherever possible, join it. Okay. So now, actually as per RBI, you should divide this by 9 or even 11.5 now, not even 9. You should divide it by 11.5. Okay. Because that is a new CRAR. So, if it comes the question of Basel, then it is 8. That is 12.5. 12.5 is correct. Okay. Next one. Read this. This is a bit difficult numerical. A bit difficult. Treasury is planning to invest in a scheme in which it has to deposit 18,250 now, for which in return the treasury would receive rupees 5,000 at the year end for the next 5 years. For the next 5 years. Advise the treasury officer concerning the investment in the scheme on the basis of the required rate of return. So you have to answer to that person on the basis of required rate of return. So this treasury is investing how much now? 18,250 it is investing. How much will it be getting? 5,000 at the end of each year for the next 5 years. So next 5 years, 5,000 into 5, 25,000 I will be getting. But what about this? Means what should I do? Means should I invest it or should I not invest it? What do you say? Think over it, everyone. Should I invest it or should I not invest it? Let me see. Comments. I'll give you 1 minute to solve this. Hardly 1 minute. Yes. Chalo, let's solve it. Okay. I've already solved this. See this. Firstly, this question is of what? It is investing in something, 18 to 50. Okay. And what is it getting? 5,000 at the end of each year. End means ordinary annuity. It is getting 5,000 at the end of each year for 5 years. So if you use the formula C into 1 plus R raised to n minus 1 upon R into 1 plus R raised to n. Okay. You should use this formula. Now the R is not given over here. Okay. Now we will have to check this. See, this is very difficult one, to be frank. First you will have to check it at 10%. R equals to 10%. So put R equals to 10% and then check it. So now, right now you have invested 18 to 50 and the present value of all the returns which you are getting 5,000, 5,000, 5,000, 5,000 for 5 years. The present value of the returns should be more than 18 to 50. Then only you can accept it. So first try it with R equals to 10%. So P equals to means present value equals to C into 5,000 into whatever I am investing per year into 1 plus R. R is 10%. 10% means what? 10% means 10 upon 100. So that is equal to 0.1. So 1.1, 1 plus 0.1 raised to n. N is what? 5. Minus 1. The whole upon R. Pay attention everyone. R into 1 plus R raised to n. 1 plus 0.1 raised to 5. This is what we will be doing. Okay. So 5,000 into this will become what? 1.1 raised to 5. Everyone do it first. 1.1 raised to 5. What are you getting? 1.1 raised to 5. Let me see in the comment section. What are you getting? 1.1 raised to 5. How to do this? Type 1.1, then type into, then type equal to 4 times. 1 less than that. Whatever is required, 1 less than. So 4 times. 1.1 into equal to 4 times. You'll get the answer. So it is, say this, 1.1 raised to 5, 1.61 I am getting. 1.61 I am getting. Are you getting the same 1.61? Are you getting the same 1.61? So do it now. So that is equal to 1.61 over here minus 1. 1.61 minus 1. So that is equal to 0.61. So 0.61 divided by, again over here, 0.1 into 1.61. This is again 1.61. This one. So 0.61 upon 0.1 into 1.61. So do it everyone on the calci. So this will become 6.1. 6.1 upon 1.61. Get the answer. 6.1 upon 1.61. So whatever I am getting over here is, see, this answer which I am getting is, for this, only this part. This part answer I am getting is 3.79. I am getting the answer of 3.79. Okay? 3.79. So if this is 3.79, then multiply it with 5,000. So 5,000 into 3.79. 5,000 into 3.79. Are you getting this 3.79 everyone? This answer should be 3.79 because I have tried and tested this. I have checked this answer many times. So this is correct. You all must get 3.79. Type in the comment section if you are getting it. Okay? Type it everyone. $3.79. Again I have checked it today right now also. So 3.79, that is correct. So 5,000 into 3.79. 5,000 into 3.79. So that is equal to 18,959. 18,959. Check this. Everyone check this. 18,959. So this 18,959 is, means what? 18,959 is greater than 18,250. See how much am I investing? 18,250. So 18,959 is greater than 18,250. 18,959 is greater than 18,250. Right? Correct? So that's why I'll accept it at 10%. I'll accept it at 10%. But what are the options? Look at this. Accept it at 10, accept it at 12, accept it both 10 and 12. Now this is confusing. Either A is the answer or C is the answer. So that's why you'll have to check it at 12 also. Put R equals to 12 now. So P equals to 1 point. Now look at this. This was what earlier? 1.1. So now it will be 1.12. It will be 1.12 raised to 5 minus 1 divided by 0.12 into again 1.12 raised to 5. Everyone, have you understood this? It is same formula. 1 C into 1 plus R raised to n minus 1 upon R into 1 plus R raised to n. Same formula. Okay? So 5,000 into 1.12 raised to 5 minus 1 upon 0.12 R into 1.12 raised to 5. Get the answer. So this is what? 1.12 raised to 5. Give me the answer. What are you getting? 1.12 raised to 5. Again, use the same logic. 1.12 into equal to 4 times. whatever is required, 1 less than that. Okay. So what are you getting? 1.12 into equal to how many times? 4 times. You require it 5 times? Correct. So do it 4 times. So I am getting it 1.76. I am getting this as 1.76. See, 1.12. 1.12 raised to 5. So I am getting it as 1.76. I am getting this as 1.76. Are you also getting it? 1.76, everyone? Are you guys also getting it? 1.76. All of you must get this, 1.76. Are you getting it? So, now, this 1.76, write it over here, 1.76 minus 1 upon 0.12 into 1.76. Do this calculation. So, this will be what? 1.76 minus 1. Okay? So, minus 1. So, that is equal to 0.76. 0.76 divided by 0.12. Everyone check this. You have to do it yourself. Divided by 0.12. So, you are getting it as 6.3 over here. 6.3. Okay? 6.3. 6.3 divided by, again this 1.76. 6.3 divided by 1.76. So you must get it as 3.609 or 3.61. 3.609 or 3.61. Anything is okay. Okay? So multiply this 5,000 into 3.61. 5,000 into 3.61. So what are you getting? What are you getting? I am getting it as 18,047. 18,047. Now this is less than 18,250. My present value, whatever I am investing, and the present value of the funds. So whatever I am getting in the present value is less than whatever I am investing. So I will not accept it. So I will reject it at 12% and accept it at only 10%. Accept it at only 10%. Kindly note this. I will reject it at 12% and accept it at only 10%. See, this is a quite difficult numerical because it's a iteration based numerical. You have to do the iteration for 10%, 12%, everything. Very important numerical from your exam point of view also. Kindly note. Because in exam also such numericals would be asked. In the treasury, VAR is used for which of the following purpose? Firstly, what is VAR? VAR is value at risk. Okay, VAR means value at risk. This means, I'll write it over here, value at risk. Okay, that is VAR. It is mainly used in your market risk. Okay, so VAR is used for the following purpose. Statement 1. To calculate the potential loss while holding the trading position in the foreign currency and securities. Calculate the potential loss, okay, for this foreign currency and securities. See, this market risk, I told you. So market risk is the main risk in banking, which you cannot count, which is not in your hands, which you can't control. Okay. Statement 2. It is used for long-term risk management. So where is it used? Is it used for long-term or is it used for short-term? So which one is true? To calculate the potential loss while holding the trading position in foreign currency and securities. To calculate the potential loss. Okay. So statement 1 is true. Obviously statement 1 is true. So 1 is true. What about second one? It is used for long-term risk management. Is it used for long-term risk management? VAR is never used. See, theoretically if you say, somebody can debate on this. Yes, why can't we use? We can use VAR for long-term also. Okay, we can use it for 1 year, more than 1 year. I can use it for 10 years also. I can use it for 50 years also. You can use it. Theoretically, you can use it. Nobody is saying no. But the question is it used? Practically, is it viable? Long-term VAR calculations will not give you the exact answer. Okay? They will not give you. It is always used for short-term, within 1 year. Okay? Check all your VAR calculations. Generally, they are within 1 year. Can't they give for 5 years? They can give, but they are not giving. Why? The reason is VR is not at all that much useful if you go for a longer term, 10 years, 15 years. Okay. So statement 1 is true, 1 only. Okay, 1 only. Statement 2, some of the books might be saying, okay, right, some of the teachers might, it is, see, theoretically you can do it, but practically it's not possible. In treasury, it's not done. Okay. See, VAR is of 3 types. Look at this. Historical VAR, I have given it over here in short, in smaller. See, VAR over here is of 3 types. One is historical VAR, parametric VAR, and Monte Carlo VAR. There are 3 types of VARs. Kindly note. Historical VAR is given by -1 into percentile loss into portfolio value. Parametric VAR is given by -1 into Z-score into standard deviation into portfolio. And Monte Carlo is given by -1 into percentile loss into portfolio value. These are the 3, at least the names you remember. Okay? Historical, parametric, and Monte Carlo. These are the 3 types of VARs. Got it? So, let's move on. Which of the following statements about credit risk spread is are correct? Always check what is asked in the exam. Are they asking you correct or are they asking you wrong? The pricing of credit is done on cost plus approach, that is benchmark rate plus spread. The spread comprises various factors that includes product specific operating costs, credit risk premium, etc. Business strategy is a component of spread under MCLR system. And last one, the spread components can be negative in MCLR. So which one are correct? The spread components can be negative in MCLR. Yeah. So, which is the true one? See the options also 1, 2, 3, 4. Only 1, 2, 3, 2, 3 and 4 and 2 and 3. So what all can be done over here? The pricing of the credit is done on a cost plus approach. Cost plus means basically your benchmark plus the spread. Cost means what? Whatever is a benchmark. Okay. For internal it is MCLR, for external it is repo. For Forex, it is nowadays ARR. Okay. So these are the benchmarks. That benchmark plus spread. So that is cost plus. So this is true. 1 is true. What about the second one? The spread comprises various factors that include product specific operating cost and credit risk premium. So that is also true. Right? Because the spread means what? The difference. Benchmark plus 2%. So it's like this. Repo plus 2. Repo plus 2. So this 2 is known as spread. This is the spread. Okay? Spread. Got it? So this 2 comes how? It is all your calculations. Your NII, what is the interest? Okay? Interest difference between the loans and the deposits. What are your expenses, operating expenses? All these. So this is also true. Business strategy is a component of spread under MCLR. Business strategy is a component of spread under MCLR. So what do you mean by business strategy? Business strategy means model, your business model. Your business model should be such that you must get some profit. Okay? So that's a part of MCLR. What are the 4 parts of MCLR? MNOP. Okay? Marginal cost, negative carry, operating expenses and tenor premium. 4 parts are there in MCLR. Kindly note this. MCLR has 4 components. MNOP, simple. OP. Okay? Marginal cost, Marginal cost of lending rates. Okay, marginal cost of lending. N is negative carry. Negative carry for CRR, or it's specifically for CRR. Okay. O is operating expenses. Operating means your salary is etc. Salary, electricity bill, all these expenses. And P is tenor premium, longer term loans, tenor premium. These are for the longer term loans. Kindly note, tenor premium is always for the longer term loans. So these are the four components of MCLR. So business strategy is a component of spread under MCLR. So what is the spread? This marginal cost. This is a spread. So this is also true. What about the fourth one? The spread components can be negative in MCLR. So spread components can be negative. Which one can be negative? This will always be positive. Tenor premium. This will always be positive if you are having a long-term loan. Negative carry for CRR. It can never be negative. Negative carry for CRR. The spread components can be negative in MCLR. Yeah. Negative carry for no. It will also be positive. Negative carry for CRR means what? What is the opportunity cost which I am losing because of CRR? Do you know what I mean by this? Opportunity cost means basically, suppose if I am giving money to RBI for CRR, okay, I have to give it in cash, okay, or I have to credit it into that account. I don't get any money for this. I don't get any interest for this. Now, instead of putting this money in CRR, I would have given it as a loan. I would have got some interest. So that is known as negative carry. That negative interest loss is known as a negative carry. So that will always be positive. You can't have a negative CRR. Okay? Negative carry over here. And marginal cost, your loan rate will always be higher than your deposit rate. So this will also be positive. So this answer is false. So the answer will be only 1, 2 and 3. Answer will be only 1, 2 and 3. Got it? Clear? Read this, again read this, everyone. Read it. Read this, very important one. Very important question this is. Okay? Clear? Read it, read it. It will take some time, but read this because this is a very important question. Got it? Done? Pause this video and then read it. Okay? Move on. Which of the following statements regarding the treasury are true? Again, you want true only. Huh? Statement 1. Treasury operates in interbank markets which are free from credit risk. Interbank market which are free from credit risk. Free from credit risk. Statement 2. Treasury is highly leveraged as the risk capital allocated is just 2 to 5% of the transaction size. Statement 3. Operational cost of treasury is very high. So which one of them is true? So you want it true, huh? Which one are true? Think over it. See, treasury operates in interbank markets which are free from credit risk. Is it true or false? Credit risk means the seller of the bond will never fail. Or if he fails, then somebody takes the risk of this. So it is true. It is true. Why? Because here, kindly note for statement 1, I'll give you the reason. Statement 1. Okay, I'll give you the reason. The credit risk part over here is covered by CCIL. CCIL gives you the guarantee because it is the operator in between. It is the agent, you can call it. Or it is a clearing agent, you can call it. So it takes the responsibility. CCIL takes the responsibility. Clearing Corporation of India. So this is true. Statement 1 is true. Okay. What about statement 2? Treasury is highly leveraged as capital allocated is 2 to 5%. This is the most correct statement. Treasury has a high leverage. You can take just 2 lakh or 2 crore rupees and do the trading of 100 crores. 2 crore to 100 crores. That much trading you can do. So it's a huge leverage business. But because of this leverage, what happens? You can earn profits. But there's also a problem. If you suffer a loss, you lose a lot. You will have to sell certain important assets of yours if you make a loss. Again, so this is also true. Third one, operational cost is very high. That is false. Operational cost in treasury is always less. Why? Because there are very few employees. Full treasury is generally managed by hardly 5-6 employees. For big banks also. Okay, some banks have this, let's say 15-20, but main are only 3-4 in any bank. Okay, so statement 1 and 2 are true. Okay, third is not true. Statement 1 and statement 2, these are true. Treasury in foreign exchange product may enter into a spot trade where the settlement of funds is done on dash day. Now this is important. Spot, what do you mean by spot? What do you mean by spot? So now you need to understand certain elements. What is it? One is cash, or we call it ready, anything, cash or ready. So settlement is done on the same day. Okay, I'll write day over here. Otherwise, I'll have to write the day. So same. Okay. Same. Suppose if I am doing it for Tom, then it is next working day. Okay, next working day. Next. Always remember the day is known as working, not calendar day. Whenever I'll work, whenever I'm open for working, normal business, then it's called as working day. Then you have a spot. Spot is what? Second working day. Second means next to next. Perso, we call it, right? And then last one is your forward. That is any day after spot. Any day after spot. Okay? Any day after spot. So this is the meaning of all these. Cash, Tom, the spot and forward. One more is there, future, but future and forward are same. Future is only organized forward, by remaining logic is same for future and forward. So, what is this now? The fund settlement is done on the first day, second day, third day, fourth day. See, this first day is cash, second day is Tom, third day is this, and fourth day will be forward. So the answer is this, third day. Okay, the settlement is done on the third day. Got it? Which of the following institutions is the nodal agency of the government of India to manage Export Marketing Fund, EMF? Now this EMF fund is given by World Bank. Okay, there are three types of EMFs: EMF 1, 2 and 3. EMF 1 is for manufacturing, specifically for manufacturing. Okay, it is given by World Bank. EMF 2 is for setting up the offices. And EMF 3 is from our own Exim Bank. First two are given by the World Bank and EMF 3 is done by the Exim Bank itself. But who manages all these three funds? RBI, Exim Bank, Ministry of Finance, Ministry of External Affairs. Who manages? Think. Everyone think over it. Give me the answer. Who will manage this? It is Exim Bank. Exim Bank manages all these. Got it? Exim Bank will manage all these. Clear? Under which method of value at risk calculation, VAR is calculated using a sample of randomly generated price scenarios. Randomly generated. So, correlation method, historical simulation method, Monte Carlo simulation method and backtesting. Think of it. Under which method we do it by randomly generated scenarios. Randomly generated means what? What is randomly generated? These are hypothetical. Okay, hypothetical. See, I'll explain you certain terms over here. Okay, first let's go one by one. Correlation method. Correlation method is used for only two elements. Whenever you want to compare two elements only two elements, kindly note. Two elements. You have this in your ABM also, correlation and regression chapter. So there also you compare only two elements in correlation. Historical simulation. Historical simulation means history. I'll go back. See, historical simulation and backtesting, they are similar. Why? Because backtesting also does what? It checks the history. And based on the history, it will give the results. Okay. Simulation means what? This historical simulation means backtesting plus the various scenarios added to it. But these are all based on history. So these two are same. Only what is correct over here is Monte Carlo. Monte Carlo is the right answer. Why? Because Monte Carlo simulation thinks of or propagates or it follows hypothetical situations. Hypothetical means what? Whatever has not happened up till now. Theoretical. Whatever has not happened up till now, if that happens, then what? Whatever has not happened up till now, if that happens, then what? Like COVID. In 2019, did anyone think that such a situation will happen in the world? That the whole world will stop for 2 years? Whole world. Nobody thought. If I would have said at that time that in 2020-21 the whole world will come to halt, you'll say, hey, nothing happens. But what happened? Actually 2021 world came to a stop, right? So that was it. That's the point. Okay? So hypothetical, this is all hypothetical situation which has not happened up till now, can happen in future. Okay? So the right answer is Monte Carlo. So this is the right answer, hypothetical. Okay? Kindly remember, these are simulation and stress testing. This is a part of stress testing. Stress testing is always hypothetical. We always check those parts which are not there, which have not happened. Back testing is historical. Okay? So here the stress testing word is not mentioned, but this is a part of stress testing. Okay? Stress and back, these are the two testing methods. Mainly they are used for your market risk in Basel. Right? See this, Basel 2, Basel 3 are mostly used in exams, asked in exams nowadays. Okay? Because these are the important elements and all the elements related to Basel 2, 3. All of them. Not only this, it can be many elements. Right? So follow all of them. And now I told you before going, I'll be showing you how to join the paid batches. See, the new paid batches, Power Packed Revision Series. Okay, this batch. Join it ASAP, only 4 days. I'll be sharing with you an important PDF which is prepared by going through an entire Macmillan book. Entire. It is prepared. Important notes have been pointed out and majority of the paper is from that only. There are numericals in that, theory in that, everything. Join the class. I'll be sharing it with you in the paid batch. Also watch yesterday's first session of Power Pack Revision Series. All the important Forex numericals have been taken. It's available on YouTube also. And then join. First watch, then join. Okay? Don't forget the code. See, the code is Y432. Y432. Never forget the code. 81% discount plus 1% extra through the app. Downloading the app will give you 1% extra discount. So don't miss this, isn't it? Take 82% discount and join us up. It's an investment for your life, isn't it? So bye everyone.